That's it. I think we should be able to finish it. I'm not positive, but we should be able to finish chapter 2, I think. So, not much to do. Don't forget that the chapter 1 exam and it was sent out an email. It was on the 26th. I'm not positive. The 26th or 27th. Question on that? All right, so let's go ahead and take and pull up the chapter 2 handout. Share this. All right, and chapter 2. So the chapter 2 handout is all about buying 100% of the subsidiary. Now, when you buy 100% of the subsidiary, you have two options. One is to dissolve the subsidiary and just take all the assets and put them in with yours. So you buy another company, a business, you take all their assets, all their liabilities, you put them in with yours, and you dissolve it. It's done. It's just like a journal entry. So whatever they have for their assets, you put those assets on your books. What they have for liabilities, you put those on your books. And again, it's a regular journal entry. And at that point, that company, or that business no longer exists anymore. And it's sometimes called a statutory merger, but it's when you buy out another company and you just take all their assets. The second one, the one that's more complex, that we're going to spend a good chunk of this semester on, is when you don't dissolve the company. You keep it going. You keep it going separately. So those are kind of like the two things that we're going to be working on today. The initial purchase of those. Okay. So here's the first one. This is on page 1. Is there anyone that did not get the handout? Did not get it? Okay. And the second one, this is the one that we're going to spend a good chunk of the semester on, is when it's not dissolved and you do consolidated financial statements. And notice on the first one, you can't do consolidated financial statements because the company doesn't exist anymore. So the second one, the company still exists. That's when it's not dissolved. And we do consolidated financial statements. We count it as just a regular investment. And then at the end of the year, we will kind of take the two companies and jam them together. It's a little bit more to it than that, but basically that's what you're doing. So the first one, you don't do consolidated financial statements because if you think about all their assets and all that will already be in your books. There's nothing to consolidate that's already in there. Okay. The basic concepts: amount paid, sometimes called consideration. This is a legal term. Amount paid is consideration. It could be cash, it could be stock, it could be a number of things. Excuse me. If the amount paid equals the fair value, there's accounting rules. If it exceeds the fair value, goodwill will be on the balance sheet. If it is less than fair value, we'll have a gain on bargain purchase, which is a really strange new one. And if they test you on the CPA exam, they're probably going to test that one. And it's a very different kind of standard than any other place you'll see in accounting. How it came about? Well, generally speaking, you can't recognize a gain when you purchase something. You only recognize a gain when you sell it. You know, so if you buy whatever, you buy the scissors, you know, probably not gonna make a lot of money. Let's say you buy the scissors. Well, you can't recognize a gain on the scissors until you sell it. Then you can recognize a gain if there's a gain on it. But you don't generally recognize a gain buying a scissors. Well, that's different for this. The rules here are that you actually will recognize a gain immediately if you pay less than the fair value for the assets. It's a very strange rule in that it recognizes the gain on the purchase, not on the sale. Okay. Types of combinations, direct costs are expensed. Broker's fees, legal, all that kind of stuff, we expense them. Indirect costs are expensed. The only costs that we do anything special with are the securities issuance and regulation and registration costs are a reduction of the additional paid in capital if you are using stock. I should put that in there. If stock is part of that consideration. So if you're giving them your stock, which is a very common thing to do, then the security issuance and registration costs are a reduction of paid in capital, which we'll talk a little bit about later. A lot of times your larger mergers will be a big company will give the people who own the smaller company their stock, and that stock has a value, and you know they work out a deal as far as how many shares of it. So for instance, if IBM wanted to buy a smaller company, they may buy them out with cash, or they might just give them IBM stock. Say, okay, we'll give you, instead of buying you out for $5 million cash, we'll give you $5 million of IBM stock. That's a very common thing to do. And then IBM just becomes this bigger company. They have the subsidiary, and now they have more owners for the place too. All right. Well, let's see here. Consolidations. And I'm going to hold off on this one. We're not going to get to this one until problem 7 and 8. Let's just jump right into the problems here. Okay, so this first one, page 3, problem 3. This is when we dissolve the other company. Okay, so we have these fair values for the assets. This is what we're going to put on the books. These are all the fair values. Oops. And these are the liabilities. Now on this one, we don't have any Goodwill or any or a bargain purchase here. I'll show you why. So fair value of the assets was 270. Fair value of the liabilities the wrong number. Everybody make a change here. Oops. Change that to 120. A typo there. A stupid typo. I didn't do it all the way through here. No, I did. Okay, I'm sorry, on problem 3. I stupidly put 150 in for the total the fair value of the liabilities. Put in 120. I'm going to try to make that even more pronounced here, but this, change this to change that to 120. I have 150 in there, that's wrong. 35,000 plus 85,000 is only 120. This should be 120. I was thinking ahead, I think, to the net. Make sure you make a change there. This should be 120, not 150. So we paid exactly what the fair value of the assets was worth. Okay, so coming down here, journal entry. We're going to take all of these on the books. Now just put this current assets on just as current assets. There could be a number of things in there, but go ahead and put them in as current assets. Land. And the equipment. And again, these are all going to go on at fair value. And the same thing with the liabilities. Now we paid them cash. Asset going down of 150,000. Hopefully, these two sides add up. Time for Mr. Calculator. So this is what we paid. We paid for it. Question on that one? It really is just like buying assets, just, like any other asset. In this case, we just paid cash. They gave us the assets and took the liabilities along with them, put them on the books. So that was it. It really is. When you're talking about this statutory merger, or when they dissolve the subsidiary, it really is just buying assets. It's no different. Okay. All right, let's go to page 2, or no, page 4. Sorry about that. I'm not doing very well today. Now, on page 4, everything's the same, except for what we paid. Copy this down just because I'm lazy. This is all the same. But notice that we paid $174,000 in cash. So notice that we paid more than the $150,000. Now, if you take it from a purely a value of identified assets idea, you say, well, that's crazy. Why would you do that? But it could be, it most likely is that there's some reason why that they are paying extra for it. It could be that the location is really good for what they need or whatever it is, that it generates, you know, whatever these assets are, they generate additional income above what normal assets of that nature would make. So this is when we talk about goodwill. This is what it is. You pay more than the identified assets. So they identified the net assets as 150,000 worth, but they paid 274 because there's some reason for it. That there's some that these assets are making more money than it's actually being than you'd expect from this. So cash paid. Oops. Also called consideration. And so the excess is going to be goodwill. $24,000. So everything is the same between this one and the last one, except for we have goodwill. I'm gonna be lazy. Copy this. Hope it works. Hey, it did. Cash paid was 174. Okay, now notice if we add up both sides, oops, this isn't going to balance out. That 120. And that's because we need to put that goodwill on the books. So the goodwill, 24,000 on the books. I'll bring that up to 294. Whoa, whoa, whoa! It's a it's a little bit pricey down there. Yeah, there we go. I want to ask you guys someone to do a non-thing, and that is, can someone just say anything over the just speak into your microphone? The reason I say it is because I'm getting this message that says that my speakers aren't working, but I think they are.
Yeah, they are working. I can hear you.
Okay, well, okay, good. I can hear you too. I know I was just, it keeps flashing up on my screen saying that my my speakers aren't working. When I test them, it shows that they are. Thank you. Okay, so there's goodwill, and it's when we pay more for than the net assets at fair value, or sometimes called the net identified assets at fair value. And this is the unidentified. I don't like that term, to be honest with you, but it doesn't matter because that's the term they use. But I guess they have to see something to set it apart. But okay. Coming down here, everything's the same again. With the exception of, we're now paying less than the fair value. So we're going to get net assets, identified assets at 150,000, but we're only paying 132,000. Which, if you think about it, that may be why we're doing this deal in the first place. We're getting it, you know, advantageous to us. So this will be called a gain on bargain purchase. $18,000. And again, this is a weird one because you really don't find this anywhere else in accounting where you recognize a gain on a purchase, usually only on a sale. I can't tell you why they do it. Because in the past, they would reduce the value of the assets by that gain. So they take that $18,000 gain and they would start reducing the assets that they bought. There's a problem with doing that. And the problem with doing that is it really causes your expenses to drop, especially like things like depreciation expenses, to be less than they really are going into the future. Because you have this, for instance, you'd have this equipment on the books, or any of these ones you write, that you'd write off, like let's say the building and the equipment are depreciable. If you reduce the value of those, that means your depreciation is going to be less. It's good, you're going to have a building that has for 140,000 for that's going to be reduced, and it's going to be producing income as if it's a $140,000 asset, where you may have in the books as 115,000. So to avoid that, they say, no, it's a one-time deal. You're going to get a gain on bargain purchase, but those are all going to go on the books at fair value. So it's kind of a different way of thinking, is that, you did a good job this year buying it at a discount, and so you get to recognize the bargain purchase. But in the future, you got to depreciate those things at the fair values. You're going to get the expenses at the fair values. Everything's going to be at the fair values for those going into the future. Okay. I'm going to copy this down. So I'm going to copy the first one down. Okay, cash paid was 132. And this is sort of the opposite of the goodwill. And this gain will go on your income statement as a gain. In the past, they used to call it bad will. That was kind of the common unofficial term for it was bad will. But now they call it goodwill. And some people have noted that goodwill comes about when you pay too much, and bad will comes about when you get a bargain. So they call it a bargain purchase now. And the important thing is that you recognize a gain on it, whatever you call it. And, as long as it has a gain there is. This is old terminology. Okay. All right, now we're going to go to some stock transactions. Okay. I'm going to talk about stocks for a second, just to kind of, you guys, I think you guys had this already in your other classes, but let me, why is this not focusing anymore? I put a new CPU in my computer, and for some reason, it reset everything. I didn't realize it was going to do that, so I got to go through and figure out why it's doing that. Okay, so I'm going to switch cameras. So stock. So here's a stock certificate. The par value in this case is $5 and $27 fair value. Okay. Second here. Okay, so now this par value, this is the minimum that the stock can be sold for. Yeah, so the $5 is the minimum the stock can be sold for, at least by the company. just issuing it. So a $5 par value says that the minimum that they can sell it for is $5. They can sell it for more than $5, but they can't sell it for less than $5. It's there for a number of reasons. To make sure that people's their investment isn't diluted. For instance, I sell you shares of stock for $5 a piece, and I turn around and sell it to my brother-in-law for $1 a piece. Your ownership just became diluted. If there's this par value, I can still sell it to my brother-in-law, but the minimum I can sell it to him for is $5. So it's there to protect shareholders. It's also there to protect creditors too. But some states require there to be a par value on the stock. Now, they can also sell it for more than that. There's nothing wrong with selling $5 par value stock for $10, $20, whatever it is. And that's kind of what we're looking at here. Now, the additional amount is called additional paid in capital. Sometimes called APIC, often called APIC. But it's going to be the additional amount over the par value. So let's go back to the. Okay, so if this has a same terminology. So if this has a fair value of $27, okay, the par value is $5. So the additional, it's up a little bit. So the additional paid in capital would be what, $22 per share? Oops, get H in there. And this additional paid in capital, you'll often see it called APIC. And so this is the additional amount. And again, there's nothing wrong with selling it for more than the par value. Because if, for instance, if you bought the stock at $5 and they sold the stock to somebody else for 27, that means the company has a lot more money of somebody else's, and you all have equal shares. So you just became enriched. So you're happy if they sell it for more than the par value. If you're a shareholder. Oops, that's not it. All right, so. Okay, so let's take a look here. Okay, so our consideration is the stock. So common stock, $5 par value. Was it 25,000? And the additional paid in capital would be 5,000 times $22. Oops. And again, this 22, the additional paid in capital would be what's on that so far? Additional paid in capital is just over what the par value is. Honestly, many people have thought we should move away from putting that on the books. The par value for the common stock, just put it all in capital stock account. because it really doesn't matter too much. And you'll have some companies that'll have a par value of 50 cents and their stock is selling at $230 a share. And it's like, well, why do we even do this? So, but we do it. And so that's why we're going to put these on the books. But in this case, the consideration is 135. So we're going to have Goodwill pay more than the fair value. So this will be Goodwill of 15,000. Okay. So
just to confirm, Professor,
yeah.
Goodwill, that will be the difference between the net asset, right? And the total consideration?
Yes. Yep.
Okay.
Yeah, so we're giving them 135,000 worth of stuff, in this case stock. They're giving us 120,000 worth of identifiable assets. And so the Goodwill, this is the unidentified asset.
Thank you.
And again, that's not my term, but it's a term you're going to get on the CPA exam, so it doesn't matter if it's my term or not. That's what you're going to get. So it's the one we need to know. Okay, so we're going to put these on at the fair values, just like before, 10, 15, 110. And the Goodwill, $15,000. And now we got to put on, we gave them, and this is a very common one to have, we'll have common stock. $5,000 at $5. And I'm going to abbreviate this, and feel free to do this, by the way. You'll actually see companies will just list it as APIC. We won't even bother to fill it out. So the APIC would be I'm going to do a little bit differently else today. $5,000 times fair value minus the par. Yeah. Or just the 5,000 times the additional paid in capital, which was $22 per share. And that would be the oops. And just get a little additional space here. So I'm going to say put the totals in just to make sure this comes out. All right. I did something really, really wrong. Came out, it was $76, which can't be right. Oh, I know what I did. Okay, who has it? What did I do stupid here? Look at my journal entry. I forgot something very important to put on the books.
Rent, current assets.
Cash? Or
The
is it cash or?
No, we didn't have any. This is actually a non-cash deal. We just gave them the stock.
right.
But I did forget something. I'll give you a hint. I put two things that are very important that I left off the books.
Total consideration? Hmm.
No,
The liability?
The liabilities. Yeah.
Yeah.
I didn't put any liabilities on the books.
Oh, shit. Yeah.
Oopsie daisy. Okay, let's put the liabilities on the books. I was teaching you guys how to cook the books there. That was part of our, just leave the liabilities off. So, okay, so accounts payable and loan payable. But by the way, that is why we kind of add these up. You know, it's a good idea to add them up because it'll tell you when you forget something very important like liability. So 10,000. And loan payable. $35,000. And I need to get a little more space here. All right, so the totals are 180,000 here, and that should also be 180, hopefully. Yay, okay, much better. And so these two together are put on the books, and those are the amount that we gave up, I'm called consideration, to get this merger. All right, let's stop there. And let's say be back at $6.58. Let's be back at say 7:08. Actually, I'm gonna try to see if I can put that on this page so I can move this up. Okay. Let's go ahead and take a break and then we will. Sorry. I think I'm going to skip to the this number 7 because I want to get to problems 8 and 9. So when we come back, we'll start out with problem 8. All right, go ahead and get started. So today, the second we're going to cover, this is kind of going to be a start to the rest of the consolidation stuff. Chapter 2 and 3 exam is combined, and this will be the kind of the first step. This is when you buy a company, you're not going to dissolve it though. You're going to keep it separate. So it's going to be listed on your books as separately as an investment. So you put on the books as an investment. When you go to do consolidations, you have a problem. And I'll show you what it is. The problem of it is, I gotta make another announcement too. So it's in the handout. This is the handout. You can put the answers in the handout. There's also an Excel, if you want to put it in the Excel sheet, there's an Excel sheet that has a blank, you can fill in. And yeah, so you either one of those. I'll probably use the Excel sheet, and most people do use the Excel sheet, and for those as we get more and more complex. But you can use either one; doesn't matter to me. And a lot of most people either use the Excel sheet. And then people also like to print it out and do it by hand, and there's nothing wrong with that at all. That's a good way to do it, actually. But so anyway, as we go through here, it's going to just be called like they usually call this like a worksheet or a spreadsheet way of consolidating the two companies. But I'll tell you what the problem is with consolidation first, and then I'll go back. We'll go up to the rules of it. Okay, here's the problem. So this bill company, they're operating completely separately. They were not dissolved. But here's the thing. The bill company is included in this investment. So this investment is really a bill. So notice what's going to happen. If we just take both these financial statements and jam them together, we're going to be counting bill twice, because bill is in that investment account. And we're going to put all bills, assets, and liabilities and all that kind of stuff on the books too. Those are actually one and the same. So we're going to be counting the investment account, which is bill, and then all of the assets and liability, which is bill. So what we need to do is do what they call the elimination entries, or the I should say not elimination, consolidation entries. Also, it's getting cold back here. That part of the basement is not insulated, so you notice right away if that door is open. So bill is in the investment, and bill is also. So we have to eliminate that investment account, because if we're taking a financial statement and saying, look, all bills' assets are our assets, all bills' liabilities are our liabilities, we can't have this investment account hanging around that counts bill twice. So the consolidation entries are about for the most part anyways, getting rid of that investment account so that we don't count bill twice. All right, so let's go to, and the rules up here, all the way back on page 2. And the other ones we're going to do, we remember the consolidating entries by Sadie. Oops, wait a minute, he didn't get it. So Sadie is how we remember the journal entries. And for today's class, we're looking at these two. Next week, we'll start in chapter 3. But we're going to have the stock and additional paid in capital of the subsidiary closed to the investment account. The excess assets are closed to the investment account. So we're going to work on these two today, and hopefully it'll make sense. Okay. Back to number 8. And again, you can either use the handout. I think I'm going to go ahead and use the Excel. It's just a little bit easier to do this on. Okay. So when we look at the book, so these are assets at fair value. And we compare them to don't do that. Over a little bit. You don't have to put this in there, but this is kind of how we're going to show it here. You notice that bill company, you know, for the most part, these are all the same. Book value for cash is the same. Accounts receivable is the same. We get to inventory though, and the book value is $38.40. So we have excess assets here. I can do it right next. So, okay, so this would be. So we're saying the inventory is really worth $240 more than what Bill has on his books for. I'm gonna stop right now and say, does that make sense? So this is. Make this thing thicker so we can actually see it. Okay, so now remember, Bill Companies is operating the way they've always been operating. They didn't write those assets up because they were bought out. They've been allowed to, you know, they're not dissolved. They're going to continue on as same as before. They're going to follow all the accounting rules, which means you don't just start writing up your assets to higher amounts or anything like that. So they're going to follow all the accounting rules as if they're operating independently. Now, when we bought them out, we paid extra for those assets. Right. I mean, common sense would tell you that that's what you do. So, well, we paid more for it. They're operating under the assumption and the guidance that they just have to follow the accounting rules, same as they always have. And so over here, this will be the exos. Okay, so we have excess inventory. Our land, 2880. And the building is 2160. Okay, so here's the excess assets. Okay, well, now we're ready to start going through this here. Oh, I should check to make sure that the accounts payable and bonds payable are the same. They don't have them here, so I assume that they are. Okay. Okay. Now, notice this stock down here is really not outstanding to anybody. For Bill. The only stock that's available is for Amy. Why? Amy bought Bill. So Bill's stock, you can't go and buy Bill's stock. So even though it says it's outstanding, it's really not. No one can go out, you can't go out and buy Bill's stock. It's not on the market, it doesn't exist anymore as far as investments are concerned. The only thing that really exists as far as an equity section is on Amy's books. So we have to remove all of the stock, the retained earnings, additional paid in capital. That all has to be removed from the books. It has to be removed from the equity section because it really is not outstanding. You can't buy it. It's not. No one else owns that. It's not out in the public. Okay, so for our SAIDI rules, this is the stock. This is the S. we have to get rid of all of these. So we have to get rid of the 1440, 3600, 3120. So this is and we have to take it out of this investment account. So what we're going to do is come up here and say, okay, for the investment account, we have the taking out the stock, and I'm just going to add all those up. So we're going to try to make this investment account go away.
Sorry, what are you adding there?
These three.
Isn't that 8160?
Maybe.
Yeah, I got 8160.
Thank you. It's
I'm like, what is going on?
I made it worse. Hold on.
Can you just equal and then sum those three? I'll give you the number.
I need, you know what I needed? I needed 32. There we go.
Hey.
Okay, sorry about that. Thank you for letting me know that I'm goofing up again. All right, so we're taking these off the books because this really doesn't exist anymore. This is going to be the only thing that's going to be left in the equity section because that's the only stock that really is outstanding. Okay. So now we have to put these excesses on the books because you'll notice that this inventory, Bill has it on at 3840, as Bill should, because this inventory is, you know, they put it on at cost, even though it might be worth more. But now when we bought it, we paid an extra 240 for that. So we will put on the 240. And for land, we'll do the same thing, 480. Again, the land here is too low, right? This is lower than what we believe it is. Oh, over here. And same with the 720. We got to bump these up because Bill has them on at the lower values, which he should. And I am in the wrong part. This has not been a good night for me. Okay, these are the assets. I'm sorry, this is the asset. So in the SADI, we have stock, and then we have the assets. And we're going to take those out of investment. I think that's right. 20, 21, and 22. E20. 22. Okay, I think that's it. Okay, so we come over here to the totals. And so the totals we're going to take and add these right across. We're going to add in the 240 also. Going down here with this 9,600, we're going to subtract these two out of the 9,600. Hopefully that'll come out to be 0. And down here, these are going to be subtracted out. So this plus this, we'll get to, we'll get down there, we'll look at that one. Okay, so how much cash we have? We have 2,400. And Bill has 9,600. So this is how much money in cash we have. Same thing for receivables. You just copy that down if you want. For inventory, we have the 6720 plus 3840 plus this addition.
Quite lost. Where did you get it? That is 3,360.
These two together, the receivables.
Oh, okay. Okay. All right.
I'll give you a kind of a jump ahead thing. This is what's going to happen with these. You know, when you look at a company's financial statements, they have the consolidated ones, they just have the consolidated amounts. So this is what we're going to show to the public when we show them the consolidated financial statements. Those individually. Let's see. Oh, equipment. They forgot it up here too. Okay, now, so it's 9,600 minus the 8,160 minus, yay, okay. So this is what we want it to be. We want this to be 0 because this is really Bill, but we're taking all Bill's stuff and putting it on the books anyway, so.
Just a question. How did he get it 10,008?
Good question. We took the 67 plus the 3840 plus this 240.
Oh.
And that 240 was to get us up to, you know, these two together equal to 240, or equal to, I'm sorry, 4,080. So we had to add this on the books because Bill has this on the books at the lower amount. And we wanted to get Bill's portion up to 4,080. So we have to add 240 to it. So these are all going to get added in. It's possible they could be subtracted if we thought that they had overestimated an asset. That's a little bit unusual, but it can happen.
Okay.
Yeah. And so if we add all these up, this should be 40,320. So this is how much in total assets we have, including these 1,440 of assets that we added on to.
Just this is question. How did you get a 0? I was just trying to.
This?
Yeah.
The 9,600. So this would be an asset. It'd be a debit balance, and then we credited it for these two. So 9,600 minus those two. should give you that. And again, we really want this to be, you know, that investment account should be 0 because we already have Bill's stuff in here. And so this is what the assets would look like for the consolidation. That's all you would see. You know, this other stuff would go on in the background. Okay, and coming down here, we'll take the, you know, we have accounts payable of 3360 plus the 1200. So the total accounts payable for both companies is 4560. Bonds payable is the same. And both together. Now this is where it gets tricky because you could take this plus 1440 minus 1440 and you'll end up with just these numbers over here. Because these really don't exist anymore. They're not outstanding to anybody. So if you wanted to do it correctly, you'd say, okay, this plus the 1440 minus the 1440, and you'll notice that those are going to be the same as over here. You can simply take these numbers and put them over here. If these are all taken out correctly, that's what you should have. And hopefully, kind of wacky, huh? So, yeah, so this would be the consolidated balance sheet for Amy for the year. This probably wouldn't be on there as 0. It'd probably just be completely gone. But you know, we've taken out the investment because Bill is actually included in these numbers, and these numbers down here, they already include Bill.
I'm sorry, stupid question. And how do you know they're included?
I know what?
How do you know they're included in the other companies?
Because we just added them in. So,
right. No, I understand. I understand all the math and everything. But...
yeah.
Okay.
Yeah. So this investment though, yeah, this investment is one and the same as Bill. So, you know, this is Bill and so is this. So when we get rid of this Bill, we're only getting rid of it because all of Bill's assets and that are included here. You know, our 2400 plus Bill's 9600 is here.
Right.
So yeah, so these are Bill's actually counted in these totals.
Right.
This investment is just gone because it's it'd be counting them twice basically.
Okay.
Yeah. So it's kind of a strange thing, but when you take the two companies together, you know, this is, especially this stock area here is eliminated, and we have to make adjustments for fair value for these assets. Usually the accounts payable and liabilities are usually the same. Not always, but usually. You don't have to do anything with those usually. But Yeah. But the real problem with consolidating though is that because they are still existing on their own, you'll have this as an investment and this as, you know, the assets and liabilities will all be, oops, let me do it here. Will be included with theirs. And bill company, though, is completely separate, and they'll operate as if they're completely separate. If you look at it, large companies, a lot of times they'll have consolidated financial statements, whatever company, IBM, General Motors, whatever. They'll often have, and they're required sometimes to have, they'll have their financial statements for just General Motors, and then they'll have a consolidated that has General Motors and everybody else that they own included in there if they're operating separately, if they haven't dissolved that, you know, those businesses that they bought. You know, so you'll see General Motors and they'll have it and it'll be in their investment accounts. But the, you know, as far as the rest of the companies are concerned, but when they do the consolidated financial statements, those investment accounts disappear and you simply take all, you know, all the cash, you know, and there might be 10 companies and all the cash from 10 companies, all the, you know, accounts receivables from 10 companies and all that will be included in the consolidated financial statements. And you'll notice something too, though. Okay, so here's the parent company and their equity section. The equity section stays exactly the same. Notice that there's no, you know, extra profit or anything in there. It isn't as if anything has changed for the parent company that for their equity section, you know, the stocks and bonds and all that kind of stuff. I should not bonds, the stocks. I should make it that color, make it a different color. Let me get this color again. You know, this is all the same. Hey. So it doesn't change anything other than their totals on the for the different types of assets and liabilities. Question on that? Okay. You know, I think I'm going to do.
I had kind of a general question.
Sure.
So is Bill as a company, are they never going to have retained earnings ever again because they just close out at the end of the year to retain earnings, but then that gets closed out in the consolidating entry?
Excellent question. What's going to happen is they're going to continue to operate as a normal company. And when we get into chapter 3, we'll find out what goes on with that because they'll operate as a regular company. So their retained earnings are going to go up, right? Or down, you know, if they have income or loss, whatever. So income and dividends will have an impact on that. They're going to continue to operate as the same as they did before. And so they're going to, yeah, they're going to have changes in retained earnings. They're going to have changes, you know, they're going to have income and they're going to have dividends through the year. And actually, if you look at our, not that. If you look up here, which you can't see because I'm being selfish, I'm not sharing. Okay, so when you look up here, so we go into chapter 3, we're going to have, okay, they have dividends. That's going to change the retained earnings. We have income. That's going to change the retained earnings. These additional expenses are a little bit kooky. They go along with these go along with these up here. They're kind of these two go hand in hand. We'll talk about those later, but they're going to have dividends and income, and that's going to change the retained earnings, and we have to make adjustments for it. Yeah, so we'll do that next week. Yeah, let's go ahead and do this. We'll go ahead and do this one together, I guess. We got time. All right. Move this over. So again, these are all the fair values. And bill down here, these are all at the book values. And we have to find out the excess. This is the excess assets. All right, so see if you can figure out what the excess assets are. Okay, the excess assets are 6,000. Okay, a new twist to this one. Calculate how much is paid for goodwill. All right. So we identified assets at fair value. We paid $42,400 for it. Now we also have though these accounts payable down here. Give them my own special color, make them green. So we're going to calculate how much goodwill they have. So this is okay. So the assets, identified assets at fair value is that. However, we got these liabilities. Accounts payable. And this will be a negative because this is something we owe. We picked up, we have to owe. Okay, so I'm going to take this number minus these two. Let me do this differently. This. Let's try this out a third time. So here's the assets, here's the liabilities at fair value. So this will be the net assets at fair value. 58 minus those, whatever that is. 58,000.
30,000?
I don't, I guess a question I don't know the answer to. Yes, it is 40,000. Okay, so. Okay, so here's the thing. Cash price paid was 42. Oh, 42,400, I'm sorry, 42,400. The net assets at fair value. So if there wasn't any goodwill, you know, we should have paid 40,000. So the rest of this must be goodwill. We paid an extra 2,400 for the goodwill. We'll make that orange, whatever that color is, peach. Okay, well. So we got a lot going on here. So these are the excess.
I'm a little bit lost. Where the net asset at fair value, how did you get that?
This?
Yeah.
I took the 58 of the assets and subtracted out the liabilities. So this is sort of, I don't know if this doesn't make it worse, but yeah, that did make it worse. it's I know, I'll make these all the same. How about? I just did that wrong.
When I did it, I was getting 22,000. Is it that you added everything? Oh, wait.
I think we have subtracted it twice. The 58 minus, I think it's 18,000. So 58,000 minus 5,000 minus 13,000. And so if we were just buying the fair value of the assets, that's what we'd be paying for it. 40,000. We didn't pay 40,000, we paid 42,400. So this extra must have been for goodwill. I don't know why it does this. That makes them so, it makes these lines so faint that you can't see them. This is from up here. Okay, so let's go ahead and go through our SADI. So we have to get rid of this. So this is all the stock. This is the S and the SADI. We gotta get rid of their all their stock and their retained earnings and all that. We have to take it out of the investment. So this would be us. And I'm going to concentrate so I don't goof this one up. So this would be this plus that plus that 34. I think that's right. Okay, now we got to put these excess assets on the books. This inventory really isn't worth 16, it's worth 17. So we're going to bump it up by 1,000. That there, here. Land, additional 2,000. And buildings are additional 3,000. Yay. Now, there's actually one more asset we need.
Don't you need the Goodwill too? Because that's what I'm off.
That is exactly what we need. This Goodwill is an additional asset. And when we do our consolidation, now this Goodwill is included in this investment account. 2,400 of this 42 is Goodwill. So we're going to get rid of this investment account and put the Goodwill on the book. So this would be these are, oops. Hopefully, that'll wipe out that account. All right, so let's start these together. So their cash was 10,000 plus 4,000, which should be 14,000. The receivables are that plus that. Their inventories are 28,000 plus the 16,000. Plus we got to add another 1,000 because we got to get that inventory on their books up to 17,000. So this will be all three of those. All right, make sure this looks up. Okay. All right, now, hopefully this investment account will zero out. We don't want it on the books anymore. Yay. And
What's that? 84. Oh, you added the assets. Got it. Never mind.
yeah. And now, but don't forget this one too, though, when you're doing these. That Goodwill. You know, I should probably put that up higher in this thing. So this would be the consolidated totals. All right, so all right, so this would be their consolidated total for the assets. Liabilities, we have our liabilities, or Amy has her liabilities, and actually if these are companies, I don't think it's she's her, I just use they. But anyway, so the Amy plus bills liabilities be accounts payable will be 19,000. 35,000 for these two. And notice again, this is going to be the only thing that remains here is going to be these the equity section for the parent company is the only thing that's going to be left. I'm wondering, do I really have to add 6,000 and minus 6,000? No, you don't. You can just put it in there. It's gonna be the only thing left. That. That's it. Wacky. But it does do what we want it to do. We want to take off this investment account and consolidate and show the people, okay, and here's what you're really showing. What you're really showing here is how much stuff you control. For instance, we really don't control 20,000 of land. If you're Amy company, you really control 34,000 of land. You really don't control 16,000 of equipment, you control $24,000 of equipment. So it really is going by how much do you control. And so again, this is the consolidation that look like this.
Yeah, I have a question. So for the first problem that we solved,
yeah,
we didn't have net asset at fair value. Why are we having that one here?
Because there was on this one says no goodwill exists. We can prove this out though.
Okay, I get it now. Okay.
Well, no, it's an excellent question. So this is a if we were to take the liabilities accounts, let me give me a second here. You'll notice that the I forgot what color you put that in here. Green, okay. I already did green. You'll notice this 9,600 is the same as the cash price we paid on this one. So there wasn't any goodwill. We could have tried to calculate it. And if we had paid more, like let's say we paid 10,000, then there would have been what, 400 of goodwill. But yeah, it's an excellent question. And yeah. And by the way, just so you know, going into the future, we are going to have these goodwill calculations. So it's a good habit. You know, this is something we're going to be using quite a bit. It's a very common thing to have happen. So, question on this thing? All right. So I know it's a lot. And by the way, we're a little over here. These tend to take a long time. The chapter 3 ones, you know, this one we did stocks and assets, the stocks of the in the equity section of the subsidiary and the excess assets, and then we're going to add in the rest of the SADI, the dividends, the income, and the expenses that go along with the excess assets. Excuse me. So these take a long time. Next class, we're going to do 2 out of chapter 3, and we'll probably get through 2 problems in the 2 hours. We might get through 3, but usually 2 is about it. Because they take a long time. They're kind of tedious, and so you know, just to give you a heads up, you know, usually in the class you get through 10 problems or whatever. More likely after these is going to be like you know, 2 or 3 at the most. Okay, so any questions on that? I know it's a lot, but okay.
You're gonna upload the video by tomorrow, right?
It'll be definitely uploaded by tomorrow. And actually, my computer is a little bit faster now, and hopefully the rendering will be done quicker. I try to get all of them in by midnight. It's possible to get in before then, but by midnight they should all be in there.
Okay.
And so yeah, so now if you haven't turned it, some of you've already turned it in, the chapter 1 exam. So your job for next week is to turn in that chapter 1 exam, and yeah, and then next week we'll pick up with chapter 3. This one you can turn in. Let me check and make sure that I have that set up before I. Okay, yeah, so the chapter 2 handout is due by next Friday. And yeah. So
in this case, do we attach the Excel file to it? Because like the 2 problems that we solved for wouldn't be on the, how do you call it, on the Word file. So how is it going to be on?
You submit both of them.
Okay.
Submit both of them. And by the way, all of the assignments and even the exams in that, they have unlimited submittals. So you could submit, if you did them by hand and you took pictures of them, like 9 pages or whatever, you can just submit the pictures. So yeah, just submit both the files, the Excel file and the Word file if you did it in both, like I did.
Like separately, right? So you submit maybe the first one and then you submit the Excel file separately.
Yeah, however you want to turn them in, you can. I'll take them in whatever format you have them in. And then again, you can submit, you can submit as many as you want. I'm sorry about that.
Well, we pretty much covered